Okay, everybody, thank you for attending the session today, Millionaires Made in Recession. Certainly challenging times and times to take advantage of the coming opportunities, because there are already opportunities. We are seeing some prices softening in some area. I'm speaking to investors around the country, and certainly seeing whoever is on the market currently is definitely looking to sell and will be willing to make concessions on the price. So if you do see a property that is of interest to you, take into account that the asking price is not necessarily what you're going to pay for it, and be ready to negotiate with them. So this is a courtesy call on behalf of the MIH Mastermind team, Marco, myself, and whoever is members of our community is, of course, here as well. So thank you. And now we're going to go with Marco on the section. It's going to take about 20 minutes or so, just for Marco to answer some of the questions which we really want to know. Marco, what are you doing today to prepare yourself for this recession and the market cycle compared to what you have done back in 2007 and 2012?
All right, so I made some bullet points, which I'm going to go over. If I go fast and anybody has questions, just throw them in the chat and we can answer them later. Before I even start, one thing, guys, not just for this podcast, for the future, 20% of what you hear is retained. 50% of what you see is retained, and 90% of what is written down, you retain. So I have this argument with a lot of people sometimes. You don't have to take notes tonight, but in the future, when you attend something that's really important, if you're not a good note taker, I would start taking notes. Because when you're laid back and you think you're doing something, 20% of what you hear, you're going to remember. And you saw it and you think you did it. Yeah, I did it. But 50% of what you see, that's why I put some highlights, because I really want these to stand out to you. And if you take notes, you'll have them to review. You'll remember 90%. Pen to paper is important. So if you really want to learn, you take notes. So it's not about tonight. That's about the future. It's something really important. I take notes on every education platform I do. I go back and I review it every month. I finished the Jake and Gino platform. I redid it once again. I did it a second time and I took notes on it. Okay, so going on, what am I doing today to prepare myself for the recession and market cycle compared to what I did in 2007 to 2012? In 2007, I was a young guy. I made a lot of mistakes. I knew how to make money in a good market, in a good economy. So the first bullet point, I had very low liquid reserves. But the one good thing I did, because I had an old school Italian dad, I had very low debt. And my brother too. My brother taught me not to live with big debt. I lived within my means. But the problem was, I invested in New York real estate with my brother in shopping centers, and I invested in a 4-family, and I had a restaurant in the building. So I invested a little bit too much of my money. So right before that recession, I didn't understand recession. So if I understood a recession, I wouldn't have invested all my money. I would have kept some more of my reserves. I would have been a little bit more liquid, which I am now. That's what I learned now. So I learned from my mistakes. So for Will, if you've never been through a recession, this is really important for you. You need to be, from this recession, there's going to be another one in 10 years, in 7 years. It's cyclical. So when you learn, the next time you see you're at a top market, you want to keep yourself like Bill Thorne. He sold 3 of his properties. He is liquid. He sold them in 2018 and 19, I think, as he was telling me. The best thing he ever did. He's prepared for this now. All right. And he got like ridiculous money for it. So I had low debt. So the next bullet point, another mistake was I got off the phone with Gwaith today. I don't know if he jumped on. He's supposed to jump on this call tonight. I talked to Gwaith yesterday. I had a $300,000 HELOC on my house. One good thing I did was I had a $1.1 million house that I bought. I only had a $250,000 mortgage. I had a lot of equity. So my father told me, you didn't want me to have a big mortgage because my taxes were high. So I pulled a $300,000 HELOC, which was great. But in 2007 and 8, the banks crashed. They went bankrupt. So I couldn't believe this. I got a letter in the mail that they closed out my credit line. Meanwhile, I have 750, 800 credit. I have a little bit of money in the bank, and they shouldn't do that to me. So I called my brother, and I said, why would they close my line out? He says, they're doing it to everybody. So that mistake is, I didn't have experience with that. I should have taken that money out, put it into my bank account, paid the 2, 3, 4% at the time, whatever it is. I think it's 1.99 right now, even if it was 4 back then. But I didn't know that because it never happened. So now in this recession, depression, pandemic, I just got approved. I closed on a new house in Florida where I am now. I just 3 weeks ago, I'm pulling a $250,000 equity line. I talked to Gwaith. He just pulled one this week too. I'm going to take the money out in case the banks crash again or whatever, or they close it on me. And I'm going to have it they can't because I'm going to have it in my bank account. So that's really important. Me not doing this in this recession really hurt me. I got through it, but that 300,000 could have protected me and I could have invested in really upturned properties. That was the thing I was pissed about because I knew me and my brother were going to invest and I needed that money just to get me through to put it into properties that were going to come up. Next bullet point, very little understanding of the market cycle and how it works. I was a young guy. I was buying shopping centers, a 4-family. We literally did the underwriting of a 4-family. You could do it on the back of a napkin. We didn't have Jake and Gino. I had my brother who was very smart with real estate, but I didn't understand market cycles. I was too busy working. I was a W-2 employee. I was working my butt off at the restaurant. We were busy. So I always had the excuse of being busy. So you have to stop making those excuses and you need to make time to learn the important stuff in life because your W-2 is important, but you need something else in your W-2. Okay. So I didn't have a market cycle understanding. The next thing was no support. And I think this is one of the most important things I teach nowadays in my mastermind. My proximity was me and my brother and my immigrant father. My dad taught us, you have your great job at the restaurant. You have your brother. You don't invest with anybody. You don't trust anybody. Just you two, no partnerships, no proximity. It's okay. You work hard the rest of your life. You make good money. In a recession, you stick it out for 3, 4, 5 years. And then when it's good again, you make good money again. So I had no partnerships. Proximity didn't exist, which I teach, and not enough education on economies and multifamily. And I had no mastermind. So now when you go down, things that I'm doing. So those are like those mistakes, things that I'm doing nowadays to be ready. So as you guys saw, I sold the restaurant February 24th. And a lot of people call me, oh my God, you're so lucky. You sold it right before the pandemic. Joking around, I say, yeah, I'm lucky, but I'm not lucky. You know why it sold February 24th? I was supposed to close the second week of January. I have education on market cycle now. Ever since 2012, I started educating myself. I know when it's in recession, a downturn, upturn, and top market. In 2016, when my brother was fully out of the restaurant, 16, 17, 18, I had 3 great years at the restaurant. 2019, I saw the numbers acting weird at the restaurant. Not only that, from 2011, we started buying properties in the upturn, which were giving us a 30 to 50 to 60% return. In 2016, we still got those properties. In 2017, it started to slow down. We're buying 5 to 7 properties a year from 2012 to 2016. 2017, we bought 3 properties maybe. 2018 and 19, couple properties. And the returns in 2018 and 19 were starting to come down to 15%, 12%, 8%. So in 2019, I'm an investor. I was still doing deals at 8%, but I saw that Isaac Chang called me and he had an $8.5 million offer on a property, and it sold in 5 days with 10 offers, and it sold for $10.5 million. And his conservative underwriting was correct at $8.5 million, and somebody bought it at $10.5 million. So if that doesn't give you an idea of what market cycle you're in, then you're not understanding market cycles. So that's one thing. And so I sold a restaurant, and investing. What I did was this time in February of 2019, I got out of the restaurant, came down to Florida. I left myself more liquid this time, as you saw up above. I closed in my last 2 deals. I closed a 52 unit with Darren, Jake, my brother, Greg Scully, a big team of ours, a good team, an awesome 52 unit in Knoxville, 2-bedroom townhouse bricks. Original owner, 1990, he built it, 7 years old. We underwrote it at 10%, 8 to 10% return, and actually cash flowed 17% on the first month. So that was one of my last properties. And then I did a 49 unit also with Darren, Greg Scully, Mike Constancis, Lisa Ward, Tracy and Barrett, Marshall Friedman, another great team that we built. And that property, both of those properties, I was supposed to put a little more. I actually pulled back and put a little less, but we still had enough in the team because I want to leave myself a little more liquid. Those are the last 2 deals I want to do. We got those done, and then the pandemic hit. So now, here's another thing I'm doing. I'm pulling a $250,000 HELOC. And now, once I get it, just in case, I'm going to take the money out like I talked with Graith. I'm going to put it aside just in case we don't come out of this pandemic and something happens with the banks and they got to send out another $2 to $4 trillion and the banks fall under and nobody could pay their loans. So that's what I'm going to do. That's what I foresee. I'm hoping we come out of this. I'm putting the blinders on and one other thing now, the most important thing is partnerships. So I got on the phone. I don't know if Skip, are you on this call tonight? So I was on the phone with Skip today and he's joining our mastermind. And he has 60 units, 80 units. He's doing really well by himself. And he actually agreed with me after we had this long call, how what he is missing is partnerships. I told him right now, I don't want to do a 50 unit by myself. It's not fun to me. But having Darren Light or Hadar or Will as my partner, that's fun to me. Because when I have a management problem, we could brainstorm. JP and me, I can call him up and about our property in Atlanta. Hey, what do you need with the management? So I was explaining to him, and he's joining my mastermind. He wants to buy, he wants to do it. I told him, I said, I want to do a deal with you too. So partnerships to me was life-changing. So for the people who come into Jake and Gino and come into MIH Mastermind, yeah, you're looking for your deal. Always look for your deal, but open up your mind, change your mindset to be willing to partner with somebody, but not just anybody. You need to do your due diligence. You need to vet them, see if they have the same energy as you, the same ethics, the same morals, and the same goals. My goals are, I look for properties not to sell. I have a different model, generational wealth with passive income. I want to buy them, hopefully refi them in 1, 2, 3 years, and just live off the passive income and give them to my kids. Somebody has a syndication model. I'll syndicate, but I really don't like syndication. So you need to, partnership is excellent, but it's not easy. You need to do a lot of work on that. One of the things, be part of a mastermind, or what I wrote is even better. Jake and my brother actually pushed me because they know my networking skills and my building relationships and all that, and even the education part of it. My brother pushed me and wanted me to do a mastermind. So instead of joining a mastermind, we started a mastermind. We're filling with amazing people who are ready to do deals with us, learn with us, grow with us. We're helping them with their small businesses, with their corporate jobs, and whatever. So what I say is, join people who are on here who are part of Jake and Gino. You guys did an amazing thing by joining an education platform and a network. That's what you do. This free call, I'm going to do free education for the rest of the year. Everybody has a platform of free education because the free education is awesome, but then you got to find something or someone to do it with, to use that free education. So you could get all this education, but if you don't find the right network or community or people to join, then it's just education you take in. And for yourself, which is good, it'll help you on your properties. But when you join a network or a mastermind, you're going to accelerate your success by 10 years. Tony Robbins, it's proven, he teaches that, and it helped me. That's how I accelerated my success 10 years. When I went to Tony Robbins Business Mastery 1, I learned the mindset of whatever it takes mindset. And then when I follow people like Eric Thomas, it's you owe it to your family. When you take that whatever it takes mindset and that you owe it to your family, it's your why. It's you'll do whatever it takes to succeed. I'm doing education now. I'm putting the blinders on. It's very upsetting when you watch the news and you hear everything that's going on. And I get down, but what I've noticed is doing the education gets me energized. This call, seeing you guys on here, networking with you guys gets me energized, keeps me going. So I'm going to put the blinders on. I'm going to do whatever it takes. I'm educating myself. I'm coming out with products. I'm in the mastermind, and you have to adapt that whatever it takes mentality. In 2007, I adapted the whatever it takes mentality in the restaurant. I came out with cooking classes. It was multiple streams of income. I got LaGuardia Airport under contract for catering, 1,500 people, $23,000 job. I hooked that up in sales. I picked up Sloan Kettering. I delivered to catering to New York, New Jersey, and Connecticut. My brother thought I was crazy. but it was a whatever. When I said I was going to do that, my mom and him said, you're not doing that. You're crazy. I took a whatever it takes mentality. I bought cheap vans and I delivered to the tri-state area, a little pizzeria shop. So now I'm not in the restaurant. Now I need to take a whatever it takes mentality in multifamily and whatever I'm doing now. And whatever business you guys are in, whether you're doing loans, whatever, you need to search, dig deep. Whatever business you guys are in, it applies to everybody. We're in a pandemic, not just a recession. I was hoping for just a recession. I didn't want it to be stuck in this bullshit pandemic. So you have to adapt whatever it takes mindset. Learn how to attract money, not raise money. Comes with absolute certainty and surrounding yourself with the right team. Everybody wants to learn how to raise money. And when about 5-6 years ago, when I first did my first deal syndication that Jake and Gino did, or 3 years ago, I was raising money. I didn't know how to do it. But now I attract money because I did many, many hours of education and repetition. I constantly talk about it in absolute certainty. Through education, you become absolutely certain of what you're talking about, and the confidence comes along. If you're not confident, you're not absolutely certain, you're going to raise money and you're not going to do it well. When you can combine all those, you start to attract money. An example is, one of my friends is on this call tonight, that I have posts on Facebook that of all the calls we do, the deals we close and everything, and he wasn't liking them and everything, but I didn't think you don't think people see him. All of a sudden, he's a really smart guy, and he texted me, a really good friend of mine, hey, I'm taking a lot of money out of the market. This is like in January. And he saw things coming. And let's get on a call. I see all the great things you're doing. Let me hear about your investments. Maybe we could do something together. So people usually would have to call him and say, hey, I got a good investment, or send emails. I didn't have to do that. He called me. So I'm attracting money because of my certainty, my confidence, being proven, and him seeing what we're doing, that we're legit and transparent. So there's a big thing that I'm focusing on now, is just focus forward on learning how to attract the money, not raise the money. And the last thing is, honestly, I'm going to keep telling you guys this. 3 weeks ago, 4 weeks ago, I was really down. I was having a bad week. And I'm very thankful for Hadar, and Will was on the call in the morning huddle, even Josh. I'm a very high energy guy, as you guys can tell tonight. I bring a lot of passion. I love life. And when I'm not like that, people don't like that. So Josh saw me on the call in the morning, and Jen would say, hey, what's up? What's wrong? So I told him, I said, I'm really pissed because I see what's going on. I know it's not just a recession. I know I'm not going to get into my personal opinion of whatever's going on. We don't have time for that. But my brother basically told me to, snap out of it. And Josh was like, hey, I don't like to see you like this. I want to see the high energy Marco who brings the energy. And even Hadar told me, he's like, go have a beer, go take a walk. He goes, I want to see you back to normal. Whatever you have to do, and because of them, Josh sent me an education platform. He said, listen, he got on the phone. He's younger than me. I have more, supposedly I have more experience than him. He told me, he's like, snap out of it. Do education. You're better than this. And even guys, what I want to tell you is, no matter what field you're in, stay focused, do some education, continual networking, and it'll keep you energized and keep you motivated.
Thank you, Marco. Great point. Marco, one more question for you right now. What are you excited about these days? What's really something that you're excited about, something that you have in the background that really pushes you apart from, working on your own deals and Jake and Gino and the mastermind and everything else?
Well, I'm excited. May 5th, I'm going to get a haircut. Yeah, I got the John Travolta going on right now. No, but we're going to read this. With recession, pandemic, what is Marco excited about? So with everything bad, me and Hadar always says, Hadar, you always say this, with everything bad comes something good. Okay. Do you remember the quote that you used, Hadar, or no?
In every difficulty lies opportunity. It's Albert Einstein.
There you go. That's our mastermind quote. We use a lot of educate, all these quotes, and they're all, your network is your net worth. So but these quotes, you need to write them down and hang them somewhere. So what am I excited about? Opportunities in the next 5 years, similar to 2010 to 2016 for the young guys out there. The recession was 2007, right? To 2008 to 2012, whatever it was. We started buying. People bought in 2008. That's why millionaires are made in a down time. Kiyosaki he's ecstatic. He feels so bad for middle class, but he's like, I'm so happy because he can't wait to take $1 million and turn it into 100 million. He's buying gold. He's buying silver. He's buying real estate. 3 things Kiyosaki does: gold, silver, real estate. Gold is a God's metal, he said. The dollar's going to fail. It's already failed. It's fake. We just keep printing money. So the one thing he says is real estate. So that's what I'm excited about is now, how do we know when the upturn is? That's why you're in a mastermind. That's why you educate. You learn market cycle. You can't perfectly predict it. But I got Hadar, and me and Hadar are aggressively looking at properties cautiously. Okay? What does that mean? If we find a deal, we're looking at a deal, Kansas City, $30,000 a door. They're 2-bedroom brick, steel. They're selling at $50,000 a door. Even in a crash, if you build those, you can't build them for $30,000 a door. But I'm not going to do it because I need to walk the property. So we're going to push the owner off to June. I want to see rents June 1st too. I'm going to push them off to June, July, August. So do I think I'm going to buy something now? Probably not, but I'm going to aggressively look. But I think if somebody's got to ask me opportunities in the next 3, 6, 8 months, definitely a year from now. So I'm excited for opportunities in the possible now to the next 5 years. I'm going to do the education with Hadar, our mastermind, my brother, Jake and Gino. And I'm going to try and see if I can find these deals in the upturn like we did in 2012 where we have Courtyard. And once again, I have a lot of units. I have 1,400 plus units I'm invested in with my brother and partners. That doesn't impress me when somebody comes to me. I always say I'd rather have 50 good units in an upturn instead of having 200 units in a top market that gives 8%. I have a 26 unit property. It was a piece of junk, that first deal that everybody hears about. I put 30,000 in. It's giving me $2,000 a month. Okay. Probably more than 50%. That's what I'm excited about. Opportunities to buy properties with very large returns and a 1-year refi and roll, which we did on 15 properties. Second thing I'm excited about, MIH Mastermind keeps me going. I'm teaching and I'm learning and I'm meeting amazing people. My goal was somebody who's trying to teach us maybe to scale this business. I had a long talk with Hadar. We're not scaling it. We're doing quality over quantity. And I teach in when you build your network and relationships, do not go get 10,000 emails. I teach how to build quality over quantity, and you build those relationships and you'll be more successful with less work. So another amazing group is starting in May, and we got one starting in June. We might have 2 starting in June. But once we're about 20 people, once we get to 25, I think I'm capping it. And that's it. And then in the future, in a year or 2 years, when people start to drop off, maybe I'll add a few more people. But another thing is growing my proximity list to 30 people from 2. I'm going to try and rush because I'm going to get the boomer from 2007 when I show you that list. I teach proximity, and I taught it on one of my mastermind calls. Proximity list has changed my life. And if you want to learn that, it will change your life. And then my last thing is it's actually the first thing on the vision board, my vision board above my passive income that I want to reach is helping 20 people grow passive income and get into multifamily with my experience, connections, and knowledge. That's through my mastermind and through not even in my mastermind. The reason is the pie's big enough. What I learned is you become a go-giver, it comes back to you. And I'm a go-giver, not because I want to come back to me, just because that's how my dad grew me up. And if you guys know my brother, that's how my brother is. That's how we all are. The Jake and Gino community, we all become, Hadar is one of the biggest go-givers out there. Okay. So if I help 20 people and I want to reach my passive income to 30, 40, 50,000 a month, in turn, I'm going to reach my goal of that passive income. It's going to come back to me from those people that I'm helping. So I'd rather help those people first because I know that I'm going to reach my goal after from that. So that's one thing. The last thing I would like to show is I want you guys to work on, I learned this from Tony Robbins when I went to Business Mastery. He made me write down my proximity of 5 people. You are the sum of the 5 people you surround yourself with. 95 to 2006, I had proximity of 2, me and my brother, because my father said, you partner with nobody, do not. I had a W-2 and I made a good living. In 2010 to 2018, I achieved financial freedom from partnerships and proximity. Okay. You need to work at it. I had my brother, Jake Stenziano, Mike Gelchi, my 2 best friends, Martin Krill and Nick Puja. I reached financial freedom through partnerships. Okay. That's what I was telling Skip Fritz on the phone today. In 2019 to current, up to number 20 are my partners now in multifamily deals. 21, Bill Thorne's on this call. We will have a deal soon. I don't care if it's now or in a year. We developed a relationship. We're going to do a deal soon. And 22 to 38 is my mastermind, which once we do have deals, we're all going to be we're building teams. We're getting to know each other. We're seeing how LP, GP, whatever. I'm going to grow that proximity this year. That's my goal, to get past this pandemic and grow this proximity and grow the partnerships and really get some good deals. With Abraham Anderson, JP's on my team, Darren Light's on my team, Bill's going to be on my team, and Hadar too, which is looking in Arkansas. So this is that's about it. This proximity list, guys. My recommendation to you, what Tony Robbins had me do, is make your list of 5. You might have to take somebody off. You might have a cousin on your proximity list that's just not. You want people on your proximity list that are going to bring you up, build you up. So Tony Robbins told me it's sometimes it's tough. It's not saying you'll never talk to him again. Yeah, you'll talk to them, but you don't want to be surrounded all the time by that person. You want to be the people surrounding you who can take you to the next level.
Thanks, Marco. That was great. Thank you very much. Guys, just wanted to answer a question here from James. And please feel free to submit your questions as you go through the presentation now with Boomer and then with Will. We'll do whatever we can to answer the questions. Otherwise, we'll do another quick recording like we did in the last session to answer the questions. So James is asking if we are going to be looking at deals and beat them based on 10% cash on cash return in opposed to the 8% that we've been kind of, if you like, looking for in a hotter market. My answer to that is that more often than not, when you underwrite deals, if they're underperforming assets, they might not even be 8%. They might be negative. I mean, my deal, which I bought in November, was $10,000 negative, supposedly, on the underwriting, on the conservative underwriting on the first year. So we're looking at the returns once it's stabilized. So the stabilization time frame takes anything from 12 months to 2 to 3 years even, depending on the size of the asset, but typically it's about 2 years. So it really depends on where you could take the asset to. If you're buying a property in a location which has, let's say, 20% vacancy or even 30% vacancy, you're not going to be buying it at 8% or even 10% cash on cash return initially. It might take you a year or 18 months to get specific return. Now, my personal criteria are closer to 10%. But on initial underwriting, you're not going to be able to determine that. So again, you look for that once you stabilize. In another point of view, you really want to make sure that if you do a syndication or a partnership, what do you actually, if you like, allowing as a distribution to your investors. So if you do a syndication and you offer a 7% pref or 8% preferred return, you want to work your number on when you will be able to deliver that. So every deal is really on a base-to-base basis. Now, James, I can tell you one thing. The return that you're getting on the cash-on-cash return and the yield that you get from investment property, it's really depending on the location. If you find a great deal, which is a B-type plus asset in a very good location, I would not dismiss it just because we are supposedly in recession and you're not going to get a 10% because someone told you that you should be getting closer to 10. I done this mistake back in 2009. I look on a very good deal in Auckland, which is a very, the best market in New Zealand. And I had some coach, if you like, somebody I looked up to. I wasn't paying or anything, and he told me, "Oh no, you need to get it at 10% or more." And I basically dismissed the deal because I believed them. But even at the 8% that I got it would have been a screaming deal because the numbers were there and all of that. So it's really on a case-by-case basis and location basis and what kind of asset type is it. So keep that in mind. And of course, if you have any question, you're always welcome to shoot us a message and we can perhaps jump and have a look and see if it stacks up. Okay, yes, Marco.
Last thing before you get to Boomer. Guys, look up MIHmastermind.com, me and Hadar. If you have any questions about a mastermind, look it up and write them down and text me or give us a call. Okay, we could set up a 30-minute networking strategy session.
Yeah, thanks. And we offer that to our students as well. So everybody that join us, if they find a deal, we take the extra. We'll jump on a call with them whenever they need, really, just to review the deal and make sure that they're doing the right underwriting and everything. Pretty much holding their hands to make sure that they're bringing a good deal to the table, whether it's to partner within the mastermind or whether it's for themselves. We just want to make sure that our students as well making the right choices. So that's the way we like to operate. Now, guys, I want to welcome. Okay, we'll be in touch. Again, MIHmastermind.com. If you want to get in touch with us there, Billy, you can do that. Otherwise, we know we will be able to email you. So I've got your number here and the contact details. We'll do that. Boomer, welcome to the presentation, and thank you so much for attending today. Boomer and I met through Jake and Gino quite a few years ago now. And recently, Boomer did a cost segregation study for my latest purchase in Arkansas. It's a process that really was worth doing. And Boomer is from Cost Segregation Services Incorporation, CSSI, and he will share with us now a cost segregation study and a few other bits and pieces which are very important to know about the cost segregation. And it's very similar to the deal that he just done for me. So please, Boomer, take it away, and you can share your screen and please introduce yourself and everything else.
All right. I appreciate it, Hadar. So what I'm going to do is I'm going to give you guys a brief synopsis of what cost segregation is. I know a lot of you guys on this call have either been through the process before or are familiar through other educational avenues that you guys have taken. But for those of you that are not familiar with it, what cost segregation is when you purchase a property, everything is being depreciated as one single line item on your depreciation schedule over 27 and a half years if it's a multifamily property, or over 39 years if it's a commercial property or an Airbnb. So what an engineered cost segregation study does is it'll break your building down into probably 40 or 50 different components and place those components into their proper and shorter class lives. Your goal as an investor is to shorten down the life of as many assets as possible. So what a cost seg study does is it's going to place a dollar value on each one of those 40 to 50 assets inside your property and then place them into their shorter class life, which is going to more align them with their actual useful life. Because, for example, we know that carpeting is not going to last 27 and a half years. So as you'll see in the examples below, when we get into an actual property, what we do is we're going to place things into 3 separate buckets. We're going to place them into a 5-year bucket, into a 15-year bucket, and into a 27 and a half year bucket. Now, when Trump released the Tax Cuts and Jobs Act in 2017, he said, any asset with a class life of less than 20 years, you can take 100% bonus depreciation on and reap that all in year 1. So it doesn't matter what we put in the 5-year bucket or the 15-year bucket. Those are all going to be treated the same. You're going to be able to fully depreciate that in the current tax year.
Boomer.
So, go ahead.
Did you want to share a screen or not yet?
Yeah, I am in a second.
Okay.
Yeah. So as you're going to see in the examples below, we're going to place things into 3 buckets. For example, the carpeting, the molding, your kitchen cabinets and countertops, your light fixtures, your window coverings, your appliances are all going to go into a 5-year bucket. And things like your parking lot, your landscaping, if you have any fences or walls, things like that are all going to go into a 15-year bucket. So what cost seg does is it allows you to depreciate your property over a faster schedule, which increases your annual depreciation, which reduces your income, which reduces your tax liability, and ultimately increases your cash flow. So the accelerated method is the IRS's preferred method. The study just has to be performed by an engineering firm. So if you don't use one of the big 4 accounting firms, chances are they don't have the engineers in-house, and it has to be outsourced to a firm like CSSI. Okay, so what I'm going to do is I'm going to go through this property here, and 1 second here.
Guys, and while Boomer is setting up the share screen, I want to share with you that I rang Boomer about the deal. We actually started the conversation before I even closed on the deal. And once we closed on the deal, I kind of waited a little bit. So I closed on the deal in November last year, and Boomer got in to do the cost segregation sometime in late January. So we're going to ask a few questions for Boomer at the end about the timing of that, and do you have to do it within the first financial year when you bought it, or can you wait, or a few other questions that I got for Boomer. But what I want to share with you is that Boomer basically had to send someone to my market, and that's how they do it. They can do it across the nation. They fly an engineer in, and they do the cost segregation for you, which was scheduled with my third-party property manager. So please, Boomer, take it away.
Yes, that's correct. So what we do is we will come out to your property. We'll probably take about 150 to 200 pictures. We'll get any kind of blueprints or drawings that you might have. And then our engineers will basically go and reconstruct your building. Okay, so on this property here, we're going to look at, so a good question is going to be does cost seg only work on new properties, or does it work on existing properties as well? So on this property here, the client purchased the building and then went ahead and put in an additional roughly 100 or 150 grand of renovations and improvements. So you're going to see a lot of that in this first page here. So every single individual building has to be studied individually. So if you have an office, if you have a clubhouse, if you have 10 buildings on your property, if you have a garage, if you have a storage facility, each building has to be studied individually. Now, that's not going to matter anything to you. That simply does what we do. So here we're looking at the site, okay? So we placed a dollar value on the site of 137 grand. So we were able to pull forward roughly less than 1% into 5 and 7 year, but we were able to pull forward 75% into 15-year property. Now, like I mentioned before, it doesn't matter which bucket it goes into. If it goes into a bucket of less than 20 years, you're going to be able to fully depreciate that item in year 1. So when you scroll down to this page here, you kind of see what we broke it down to. We broke down the parking lot, this exterior signage, the sidewalks and curbs, the landscaping, the security light poles, the exterior fencing, the fire hydrants, exterior concrete pads, and the basketball court. We were able to all pull that forward into 15-year property. So we were able to create an additional $104,000 of depreciation expense in year 1 by doing this. So a lot of times it's going to be things that you might not even think about, but as you go through the process, you'll be able to see the kind of items that we're able to accelerate and move forward. So this is all on the exterior of the property. This has nothing to do with any buildings. It's all the exterior of the property.
Boomer, excuse me, can you, well, if you got more tables like that, if you don't mind just zooming in one notch so we can see it a little bit better. Oh, that's better. Thank you.
That's better?
Yes.
Okay.
Boomer, before we continue, 1 second, just to get the people who don't know a lot about cost segregation. Hadar, you did the cost segregation property. How much did he save you? Over $200,000, correct?
300.
Guys, explain it real quick, Hadar.
You will see a similar study in a minute, which Boomer is going to touch on it, but pretty much the accelerated depreciation was close to $300,000, which probably going to take me 2 years, if not 3, to use. And then there is another amount, which was, from memory, about 20 grand, which will be moving forward for another 20 years, which are not going to pay income on. So basically,
and this is why we buy real estate. The main reason.
Okay. Boomer, is this a good time just to ask a couple of questions, Boomer?
Yeah, if people have questions, you can go ahead and ask. I'll tell you what, let me get through this page, and then we can go to questions.
Okay, thank you.
Okay. So this was all in the exterior of the property. As we're going down, there's an office. So he had a small office on the property that was worth about 22 grand. So we were able to pull forward 24% of that 22 grand office into 5-year property. So things in the office that we were able to pull forward were able to be like the cabinets, the moldings, the flooring, the wall covering, the window treatments, anything specialty that you have in your property that makes the building more comfortable. Those are things that we're going to be able to accelerate. So you see here that he had a specialty HVAC dryer vent, able to pull that forward. Specialty plumbing, able to pull that forward. Any kind of signs, the lighting, the mailboxes, and then appliances, we were all able to pull into 5-year property. Then the structure of the building are always the things that are going to stay in your 27.5-year property. So things like your roof, your foundation, your HVAC, all things like that are going to stay in 27.5-year. But on this office, we were able to accelerate an additional $5 grand of depreciation into the current tax year for simply the office on the property, not any units, just the office. So this property had quite a few units. So we're just going to go through one building here. So I think there were probably 10 or 11 buildings on this property, but one building we were able to put a dollar value on 85 grand. We were able to accelerate 23% into 5-year property, and the remaining 77% stayed in 27.5-year. So these items right here, same kind of thing that we were able to all place into a 5-year bucket. So on each individual building of the property, he's going to get an additional 19 grand of depreciation, which you'll see on the next page. But the same kind of thing, all of these things here, we were able to accelerate and move from 27.5 into 5-year property. And one key thing to note is that as the client does renovations and improvements going forward over the life of the property, we've already placed a dollar value on these assets and separated each individual asset to its own individual line item on the depreciation schedule. These assets are no longer intertwined with the original building. They're their own individual asset. So let's say in a couple years that he goes and replaces all of the flooring in this. I know that this building is a few years old, but whenever a ownership changes hands, the depreciation starts over. The IRS looks at this flooring as being brand new. So in 2 years, whenever he has depreciated 2/27 of the flooring, there's still going to be a lot of value on that. And whenever he goes and throws that flooring in the garbage, he can still get almost all of that depreciation expense immediately because it's its own individual line item. It's no longer intertwined with the building. So rather than having everything intertwined with the building over 27.5 years, you're going to have things into a shorter class life, as well as they've already had an exact dollar value placed on these, because what we are is we are calculation experts, and we place dollar values on these that are irredisputable by the IRS. These are exact numbers. So, and then you kind of see down here in the building, same kind of thing. These are all things that stayed in 27.5-year property. But in a couple years, if he has to go replace the roof, or he has to replace an HVAC, or he has to replace the windows, what he throws in the dumpster is going to have a value to him because the building has been componentized and everything is no longer all intertwined together with one single line item. So going back over to what he said in terms of what the savings ended up being. So we're looking here. We got a building cost of roughly 1.1 million.
Boomer, excuse me. Let me stop you here for a minute, because before we jump into this, this is the nice part. This is the part when you can really see the money in your pocket. But before we go into that, guys, I want to share something with you. The reason I choose to use Boomer and a cost segregation company is because if you get your CPA to do it, I believe it's the straight line or the streamline, simple way, without getting it into granular, into really, really itemized through a cost segregation study, you can still be audited by the IRS, and they got a bigger chance to getting you. When you use the cost segregation engineer to do that, they will also protect you, and it's much more resilient in terms of an audit. Is that the right assumption, Boomer?
Yeah, that's correct. So our company, Cost Segregation Services, has been around since 2001. We've performed over 22,000 studies in all 50 states, and we've never had a single line item overturned. So these are completely bulletproof to you. In the event that you're audited for some reason, we defend our work 100%. The IRS will call us. We'll get on the phone with them, explain our calculations, explain our process, how things were done, and then you'll be home free. So we've never had a single line item overturned, so you have nothing to worry about. Our name's on everything. We take all liability, and we defend you at no additional cost.
Here's another thing. Guys, I have an amazing accountant, Todd Newman. He handles about 17, 20 of my LLCs. Most times your accountant, he's, your friends with him, he's a good accountant. This is a lot of work. Most accountants don't want to do this. And a lot of accountants, believe it or not, you think they do, they don't know how to do this. So they might not, they'll do it for you. They might not even do it correctly because they're so overwhelmed. They don't really want to do it. So this is his job. He takes this even more seriously than them. And you think your accountant cares about you a lot of times? Not really. I have a couple friends right now, their accountant's not doing the right thing by them. So that's why, like Hadar said, you would use somebody like Boomer who you know is going to give you a perfect report.
And Boomer also communicates with your accountant if required, and really stay in touch on the yearly updates once you, for example, in our project, Boomer, which is another point I wanted just to touch on before we get into that, is that you asked me, Boomer, to provide you all the invoices, if you like, and all the costs that that I spent so far before you've done the actual cost segregation study. So basically, I bought the property. I already spent about 150 or close to 200,000, 180,000 before Boomer did the cost segregation. So Boomer asked to see all those expenses so he could factor them in, and all the invoices so you could factor them into the calculation.
Yes, that's correct. So what we do is we don't simply want to be a cost seg vendor to you. We give you the full report, and in a few weeks when it's done, we shake hands and go our separate ways. We more want to be a partner within your tax team to help you throughout the life of the property. And we're not like an attorney. I'm not going to start the clock and bill you whenever you pick up the phone and call me or email me or anything like that. Everything is included in your cost seg study. So what we do is this is all that we do. We are experts in this. So your CPA probably does a very good job for you to file your taxes, keep you in compliance, keep you out of audit, but it is not their job to find tax savings opportunities for you. And that's why I commend all you guys for seeking out additional education, being a part of Jake and Gino, being a part of self-improvement, making yourself more aware of what's going on, because the tax laws are designed for everybody. Every single Fortune 5,000 company has used cost segregation, but the same laws that apply to Apple and Google and United Airlines apply to you and I as well. So we simply want to make you aware of the opportunities available to you. And if it makes sense going forward, great. If it doesn't, at least you know that you've exhausted every opportunity available to you. So Donald Trump is the face of cost segregation, and the laws are very, very building owner friendly right now. So now is the time to take advantage of it. And one thing to point out is that we can still do things for 2019. So if you're on extension or if you've already filed, we can go ahead and help you save money on a property that you purchased in 2019 or any years prior, and you can get immediate cash flow that you can use right now. So kind of keep that in mind. And if you have any questions, simply reach out to me, reach out to Hadar, Marco, anything like that, and then we can kind of piece it together and we'll look at your property individually here. Okay. So going back to the property on the screen here, what we have is we have a building cost of roughly $1.1 million. What that is that's going to be your purchase price, excluding land, plus the amount of renovations and improvements that were done. So you cannot depreciate land, but you have your purchase price plus any renovations and improvements that you do going forward. So what we're going to do here is we're going to look at this spreadsheet here. So are the numbers big enough for you to see?
Yeah, zoom in a bit.
Number.
Zoom in a bit, yeah, please. A little bit more. Yeah, that's good. Yeah.
That's good? Okay. So right here, we have the building cost of $1.1 million. Over here in the top left-hand corner, there's the box that says 5-year property, 7-year property, 15-year property, and 27.5-year property. So on the sheets that we looked at before, we were able to accelerate roughly 20% of the property into 5-year, roughly 9% into 15-year, and then the remaining 70% stayed in 27.5-year. So we are not taking all of your depreciation for the life of the property. We're simply taking what the IRS allows, which is roughly 30% here. So the columns that are going to matter most to you over here is going to be the 4th column from the right, which says timing difference. So we were able to create an additional $324,000 of depreciation in tax year 2019. The beauty of cost seg is it is not a use it or lose it. Whatever you don't use in 2019, you can carry forward to subsequent years indefinitely. So you're going to have an additional depreciation expense of $324,000 in 2019, and there is one cost seg done per property. However your partnership structure is split up, that's what percentage of the $324,000 you get. So it doesn't matter if there are 2 partners or there are 30 partners. There's simply going to be one study. We will work with your CPA if they have never been through this process before. All they're going to do is they're going to take their straight line number plus our accelerated number, and that's going to give them the happy number that they submit to the IRS. So like you'll see here, if you look at this column here, total depreciation with analysis, he's going to have $336,000 of depreciation in tax year 2019. If he did not do the cost seg study, he was only going to have $11,000. That's because he bought the building in September of 2019, so it's prorated for that portion of the year. So instead of $11,000, he's going to have $336,000 of depreciation to use in 2019. And then kind of like what we mentioned before, cost seg is all about the time value of money. It wants to keep money in your pocket, you the smart businessman, you the smart investor, to use it however you want to use it for. If you want to buy another property, if you want to fix up a property, if you want to pay down debt, it's keeping money in your pocket. And then going forward, he's still going to have $28,000 of depreciation each year. He would have had 40 if he didn't do cost seg. Now he's got 28, but he has an additional $324,000 in tax year 2019, and he probably won't use it all, so he can carry it forward to subsequent years.
Guys, $28,260 moving forward for 20-something years that you're not going to pay tax on. Free. Pretty much. That's
so. And then as he does renovations and improvements going forward, we'll continue to work with him to be able to expense probably 80 to 90% of what he did. That is not going to have to be capitalized because his building has already been componentized and everything's no longer intertwined. So yes, he reaps a nice $324,000 savings in 2019, but he's going to save a lot of money going forward over the life of the property because the building has been componentized.
Boomer, what's going to happen now moving forward when I keep spending money on my repositioning? I'm still going to spend, let's say, another 150 or 200 on those apartments. Now, you asked me by the end of this year, 2020, to give you the expenses that we spent within the year. What are you going to do with that?
Yeah, so what we're going to do is that we already have pictures at your property because we've already been there. We've already placed exact calculations on the components in your property. And what we're going to do with your invoices going forward is we're simply going to do what is called a partial asset disposition. We're going to take the amount that you spent in 2020 or 2021, and we're going to be able to create a new calculation to be able to save you more money on the renovations and improvements that you did in that year. So ideally, we want to help you expense as much of that 100 or 150 grand as possible, but whatever you don't use, we will cost seg the new stuff as well.
Thank you. You got anything else apart from that to add on here, Boomer?
No, I mean, this is a very easy process. Simply reach out to me. You can text me, call me, email me. And what we'll do is we'll take it and look at your individual property and your individual situation. Our engineers will put together an analysis for you, which will look very similar to this. And we'll just have your calculations up here that's going to apply to yours. But I simply need 4 questions answered. When was the building purchased? What was the purchase price? Are you doing any renovations and improvements? And what's the address? Or if the building's already been in service, your accountant's going to have your depreciation schedule, and that'll give us all the information that we need. So we will put together a no-cost analysis for you. There's nothing that you're out the front end, but it makes sense. If you've owned a property in 2019 or going forward, this is something that you need to look at because you can get immediate cash flow now in your pocket to use going forward. And then as you guys are starting to get into new properties, as you get new deals, simply reach out to me as soon as you get an LOI, and then we'll be able to put together an analysis for you that you can show to your investors, and they're going to be like, wow, I'm going to have this much additional savings in the year that we buy the property. It's a way to be very attractive to investors as well.
Well, here's a simple example for a smart businessman. You could let your accountant do it and him lie to you and he says he's going to do a good job and maybe get back, say 20,000, I make up fake numbers. Or you pay a little something in business world and you can get back 40,000 doing a cost seg, doing it right. So you know what I'm saying? It makes sense. You know what I'm saying? Do you want it done right? And do you want to maximize and protect yourself, like you said, against the IRS? So to me, yeah.
Boomer, what's the minimum value of property that you will recommend somebody to do a cost seg? I mean, would you recommend it on a property worth 700,000, or does it need to be over a million? What do you recommend?
No, that's a very good question. So with the advancements in technology and a lot of sweat equity from us doing this for quite a few years, the costs have come down considerably. Right now, if you have a property that has a cost basis, remember cost basis is purchase price plus renovations and improvements. If you have a cost basis of 250 grand or more, we can normally create a pretty compelling ROI for you. So even on smaller properties, if you have a single family home, if you have a duplex, a fourplex, anything like that, those can still work. So we're simply working off of hard numbers here. And what Marco was talking about before is a lot of times after a year, you guys will do a refinance or anything like that. That does not affect this at all. We're simply going off of hard facts, which the IRS cares about, and that's it. So you guys can choose to move your money around and do things like that. That does not affect the study at all.
Thank you. I got a couple of questions I want to still ask you, Boomer. So I'm just going to ask this because it's written down from a member. Can you do a cost seg even 2 or 3 years out after you purchase it?
Yes. Yeah, we can do cost segs going all the way back to 2001.
Wow.
On a building that far back, it's probably going to be fully depreciated by quite a bit. But I would say if you have a building that you purchased from 2010 to the present time, chances are it's probably still going to make sense. Yes. So all that happens then is that we will file a 3115 for you. A 3115 is a change in accounting form. It tells the IRS, I was doing straight line depreciation, but now I'm going to do accelerated depreciation. So your CPA will just submit that form, which we complete with your tax return, and that tells the IRS that you are now doing accelerated going forward. And in that situation, all the money that you left on the table, we will go back and pull that forward and get you caught up to the point that it looks like you did the cost seg study back when you bought the building. So all the money that you left on the table, we will get you caught up to present day.
Thank you. Another question is, what the timeline for bonus depreciation? I mean, we were able to speed up the bonus depreciation and take things down to 5 years and then basically depreciate them in the first year and able to carry them forward. But I believe that about 2023 or something, that bonus depreciation will be eliminated or scaled down. What's the story there?
Yes, so going forward, the current tax laws are in effect in full 100% bonus depreciation through 2022. In 2023, it goes to 80% and then 60% going forward. We'll see what happens with the election coming up. These things might be extended longer, but in the current tax laws, yes, it's still 100% bonus depreciation through 2022. And it doesn't matter if we have a change in the White House and the tax laws change. If you do the cost seg study before 2022, you're going to be grandfathered in and you're still going to reap all of the benefits.
Okay. Let's see what other questions we got.
Hadar, we got to, maybe even the questions that don't get answered, we're going to give them to Boomer and we'll have him answer them. We'll email him because we got to, I don't want to run too long. I want to move on to Will.
Okay.
That's perfect. So feel free to reach out to me. My email is just my first and last name, boomerphilbrick@gmail.com. Or you can simply call me or text me.
Put it up on the chat while Will talks. If you can, put it up on the chat. If you hit the chat button, put it up. And then guys, really email him the questions because I want Will's got a great presentation and he will answer your questions and he's going to network with you. So really reach out to him. Okay.
Yeah, Boomer is great. Thank you, Boomer. I really appreciate your time.
Great.
And,
thank you.
It's awesome to have you around, man.
All right, you got it. I'll talk to you guys soon.
Thank you. Will.
Yes, sir.
Where are you?
How's it going? Can you see me? Hear me?
You want to give him an introduction, Hadar? You want me to introduce him?
You can introduce him, or Will can introduce himself. Who is sharing?
Will's my boy. I'll introduce him. I know he's your boy too, but so guys, this is Will Coleman. I'm very grateful. We work together, me, him, Josh, my brother, every morning on Morning Huddle with Jen. Will joined the team at Rand Capital. He's doing loans. He's going to explain to you what loans and everything. And he's going to do a great presentation for you. You guys should get his number. Same thing, email him questions, network with him, give him a chance to compete for your loans. You always want to use more than one person, but we definitely give Will a shot when you need a loan. All right. So go ahead, Will, take it off.
Will, please,
Sure,
please zoom in a little bit, man, so we can see the whole screen, like full screen.
Yeah. So are you seeing
Taking the stress out of financing?
Right, but is it showing like can you see show taskbar here? Or is it just the
show
full screen?
taskbar, display settings, and slide.
Okay, I got the wrong one then.
Okay, take your time, man.
Let's see if we can figure this out.
Take your time, guys. If you do have any questions, this is still a time to post question in the chat. We'll collect them at the end of the session and send it to Boomer or send it to anyone if you have questions for Will as well, or any question for Marco and myself. That's
okay,
good.
Is that better? Is that full screen now?
Yeah, man.
Perfect. All right. Cool. So my name is Will Coleman. I'm with Rand Capital. Just a quick background on myself. I worked at a community bank as an analyst for a while and recently joined Rand Capital here in January. So Rand Capital, so from Texas and then now living in Tennessee. Rand Capital, really our goal is to help you find the best type of financing for your deal. So there's a ton of different options out there, depending on the deal size, the borrower, and the type of deal, and your business plan will really determine what type of loan you want to get. So you can see here, basically, you get your borrower, you come through us, and then we help you find the right loan. So we'll get to know you as well as your deal and determine based off that what is the best loan. And I understand it's late, so I'll try and make this quick. If anyone wants to check us out, randcapllc.com, or if you want to take a picture of this, just so you have it if you do want to head out, because generally I go to bed around 8:39, so we'll see how that goes. So first, starting off with the different types of financing, like I said, there's a ton of different options. The main types that I really see are community bank, so your local lender, whether it's Green Bank or Veritex or Citibank, just the bank you see on the corners. agency debt, which is Fannie and Freddie. These are going to be the larger loans, $1 million or more, non-recourse, very beneficial loans for multifamily. I mean, they're designed.
Will, real quick, for non-recourse, for people who are new to it, because I didn't know non-recourse until I actually got into this with Mike Elchi and my brother. Non-recourse, explain to them they're not responsible for the loan. Is that correct?
Sure. Yeah. So I'll go through kind of the differences here. But to answer your question, recourse basically means that you are liable for the deal if it does go bad. So a community bank, for example, is going to underwrite the property, and then they're also going to underwrite you as a borrower, because they want to understand if the deal does go bad, they're able to go after your personal assets. Some assets are protected. For example, your residence is protected, and I believe 2 vehicles. It depends on the state, and I believe your 401k. But besides that, any rental property you own, any personal property, any artwork, if the deal does go bad and you have to pay back the loan, the bank can literally go after your personal assets in order to make that payment. Whereas non-recourse, which is one of the benefits of agency, is that if the deal goes bad, you can essentially wipe your hands clean with the deal, and it doesn't go on your credit. It doesn't really affect you bad. And they can't go after your personal assets. So that's kind of the main difference between recourse and non-recourse. Community banks, they will offer it. I mean, community banks, that's one of the benefits of community banks. You can get them to do whatever, really, but 99% of the time, they're not going to be willing to do that.
Yes,
and then,
Will, I'm sorry. Let me just mention that when you get a non-recourse loan, you're basically getting a loan which is not counting against you from a serviceability point of view. So if you buy a property, for example, and you take a community bank, and when you want to buy another deal, then they look on your serviceability, on your global serviceability, as it's called, in terms of which loans you need to pay and your asset and liabilities. So when you want to buy another deal, they will look at your existing borrowing and say, oh, yeah, he owes this and this, and it reduces your serviceability. You basically have more debt. But when you have one of those loans, perhaps within your portfolio as a non-recourse agency debt loan, that means that it doesn't count against you from a serviceability point of view. It's actually almost like having a business which generates income with no liability. Is that right, Will?
That's correct. So a community bank will look at the assets you have on your personal financial statement as well as your liabilities. So even if you own let's say a $2 million property's got a $2 million loan on it, and even if you own that in an entity, if it's recourse debt, it will still show up on your PFS as a liability. So the bank will see that you've got $1 million in cash, but you also have a $2 million liability on your personal financial statement. Whereas if it's a non-recourse loan, that liability is completely taken off. So it increases your net worth essentially, and makes it more favorable for community banks to lend to you. And so it will increase your ability to get loans, as well as you're not personally liable. So non-recourse is a no-brainer if you can get it.
Okay, let's carry on.
Sweet. So, and then the third option is bridge debt. So one of the downsides of agency debt is if you're going for a loan that's SBL or SML, meaning it's less than about $7.5 million, agency is not really willing to include rehab into the loan. Meaning, if you're going to buy a property and put rehab into it, you'd have to bring almost all of the rehab yourself with your own cash. Whereas bridge debt gives you the ability to include the rehab into the loan. So let's say you're going to buy a property for $1 million, and then you want to put $500,000 of rehab into it. A bridge loan will give you the ability to lend 80% of the total cost. So your total cost would be the $1 million purchase price plus the $500,000 rehab budget. So you can get a loan for 80%, whatever that number is. So you can essentially bring less to the table, which increases your overall returns and overall IRR as a deal. So agency, that is an option, but they really like to see it on loans that are $7.5 million or higher. So those are kind of the summary of the different types of lending. The main difference, community banks are generally smaller. You can get into 15 millions, but they're really not super comfortable in that level. And if you're doing a loan of that size, you might as well go agency or bridge. It really just depends on the relationship. This is the amortization you're going to see. Community bank is going to offer 15, 20, 25-year amortization generally. There are 30-year options out there. Agency is always 30. So that's the benefit. Like I've seen people that have, like you can get a higher loan amount with an agency property than you previously had with the community bank. And due to the longer amortization, you can get a lesser loan payment. So again, agency is really the optimal financing type for multifamily if it's achievable. And I necessarily won't go into everything here, but rates are generally a bit higher for community bank just based off the index they're based off. We've already touched on recourse. Community and bridge debt have the ability to not require an occupancy standard, meaning that you can go to community bank with a property that's 65% occupied physically or economic and still be able to qualify for a loan. You just have to prove to them that you can operate the property well enough to get it to where it can meet the DSCR. And the DSCR is essentially your NOI divided by your debt service to see that if your NOI is 20% greater than your debt service, it's a 1.2. So they'll have DSCR requirements to qualify. So community bank and bridge debt, if you have a property that's not occupied at 90%, those are going to be your first two options to look at. Whereas agency, they do require a 90% occupancy, a physical occupancy. So agency debt, again, is the preferred option. It just you have to qualify for it. You have to check all the boxes. It is kind of it's harder to get into. There's a little bit more requirements necessary, but it's the optimal type of financing if possible. Interest only, community banks will generally tie it to your rehab. So if it's going to take you 12, 24 months to do the rehab, they'll tie the interest only period to that. Agency, you can really negotiate it as much as you'd like. It's just going to affect your pricing. So if you want 5 years of interest only, it's possible to get, but your interest rate on the loan might be a little bit higher, simply due to the relationship between risk and return for the bank. So if you're paying interest only for a longer period of time, then it's riskier for the bank. So they're going to want a higher return on it, which you're going to get in your interest rate. And then the DSCR kind of spoke about that. Community bank and bridge debt, you really just have to prove the pro forma, whereas agency, depending on the market, you have to meet the DSCR day one.
Yes, and
So
Will, thank you. Just want to mention, no investor left behind. DSCR is debt coverage ratio, debt servicing coverage ratio, which means you have to have a certain amount of rent to cover your debt. So that's just for the new investors who don't understand yet the terminology, debt coverage ratio. And the difference between economic occupancy and physical occupancy is basically that you might have, let's say, just to round the number, a property which is 100% occupied. You have 100% full units, but you have 10% of those are not paying. They're still there. You still have bodies in the property. There's still people living there, but they're not paying. So that's 90% economic occupancy. Just wanted to clarify those, Will. Thank you.
Sure. Yeah. Thank you, Hadar. And feel free to take pictures, guys, if you want. I know it's a lot of info. I tend to do that. So I specialize specifically in non-recourse loans for $1 million or higher, which is normally Fannie or Freddie, and then some bridge lending options as well. So these are the qualifications for Freddie Mac and Fannie Mae.
Will, real quick, let me jump in. What are you, Will@jakeandgino.com? What's your
It's will@randcre.com.
Okay. Guys, if you want the slides or if you want any info, email him tonight after. He'll send you everything over and network with him. Okay.
Yeah,
Go ahead,
hit me up. So in order to be a qualified borrower for Freddie or Fannie, being the agency lenders, you need to have a net worth, meaning your assets minus your liabilities. It needs to be equal to or greater than the loan amount. So if you have a loan that is 1 million, then your net worth needs to be equal or greater to that. and that's kind of another thing we're looking at in terms of recourse versus non-recourse debt. That'll help with that. Liquidity, they like to see 10% of the loan amount post-closing. So that means after you put the down payment down, you need to have 10% of the loan amount in liquidity. I will say it's more of a rule of thumb, and you can get a little bit lower than that if you need to. The lowest amount possible that I've seen is going to be 9 months of debt service, meaning if your loan payment every month is $1,000, after you close, you need to have a minimum of $9,000 in your account. But right now, I would try and hit the 10% of the loan amount just because of the environment we're in. And then the third one down here is going to be ownership experience or third-party management. So I'll touch it base with it a little bit here in a second, but Fannie Mae will not lend to a new borrower, meaning that if you have no experience owning a multifamily property, they're not going to be able to give you a loan if you're going from two single-family properties to a 100-unit deal. Freddie Mac, however, will allow that. You just have to have a third-party management. So you have to meet one of these two criteria in order to qualify on that end. And the fourth is just confidence of execution. Like, you need to prove that you know what you're doing, and you need to prove that you can bring the cash to the table. A lot of that is just showing the liquidity. This is more subjective, but really these are the three things that you need to meet. So this is a lot of information. I definitely recommend taking a picture of this, and I'll go over it relatively quickly. But essentially, Fannie Mae and Freddie Mac are entities that were created by the government. Fannie was created in the late 30s after the Great Depression in order to push liquidity into the market. So what happened was there wasn't enough liquidity going throughout the market. Borrowers couldn't get any capital. Banks weren't lending. So Fannie was created in order to go into the market and purchase loans from banks in order to give them free up their balance sheet so that they could continue to lend to borrowers. So Freddie and Fannie's purpose is to provide liquidity to the markets during a downturn. And so you're really seeing that happen right now. And, they're following through with what they were set up to do. And how it works is they delegate the underwriting, the servicing, and the selling of loans to specific lenders throughout the country. So Fannie and Freddie aren't specifically servicing the loans. They'll give it to different lenders. So you have Arbor, you've got Hunt, you've got Greystone. There's numerous lenders that Freddie is willing to give the ability to, they can look at the deal, they can underwrite it, they can approve it without having to send it to Fannie or Freddie for approval unless there's certain criteria that needs to be met. So I bolded some differences. One that I already spoke about here, borrower experience. Fannie will require some level of experience. They like to see ownership of similar size. So if you're going to buy a 100-unit, they like to see that you've purchased a 100-unit in the past. Freddie Mac, for example, will allow a borrower that doesn't have experience, but they really like to see that you need to have some level of third-party management company. Capital expenditures, I touched on that. Supplemental loans are an option. It really is, again, conventional only. So a supplemental loan is, let's say you've bought a property, you've owned it for a couple of years, and you don't necessarily want to refinance, you just want to get a second loan on top of that. That's what a supplemental loan would do. And the really only criteria is you have to wait 12 months after purchasing the property to go for that. And right now, they're requiring full P&I reserves. And I'll touch on the P&I reserves due to the environment we're in right now. But it almost doesn't make sense to do a supplemental loan right now, in my opinion. Both Fannie and Freddie loans are fully assumable. So I was thinking about what you guys might want to hear as an investor rather than me talk about boring facts. And one of the things is, how can you purchase a property in this environment and avoid P&I reserves? Assuming a property, I think, is going to be a really good potential to do that. So if it's essentially taking over the deal or taking over the loan from an owner. So rather than going and getting new debt, you can assume the loan that's on the property. There's a few fees. It does take a bit longer, but you don't have to bring to the table the P&I reserves that are being required right now. So that's a way to get into a property without going through all that. And just make sure that you're okay with the terms that the owner has on the deal at the time. And another major difference between Fannie and Freddie is the prepayment. Fannie is generally going to be yield maintenance. So that should say yield maintenance, but Fannie is generally going to be yield maintenance, which is more expensive. It's if you're going to buy a deal and sell it in a couple of years, I wouldn't recommend yield maintenance. I definitely recommend trying to get some sort of step down on the loan, which is essentially when you sell the deal in year one, you're paying 5%. You sell it in year two, you're paying 4%, and et cetera, and et cetera. So that's that. So Freddie and Fannie both kind of price loans a little bit different in order to determine what your leverage is going to be and what your pricing is going to look like. So Freddie is a little bit more market-based. So what they'll do is they'll look at markets, they'll look at the job diversity, they'll look at the population growth, they'll look at the income, and they'll select different markets that are considered top, standard, small, or very small. And then that will generally determine the amount of leverage you're willing to get. The next slide, I have a list of markets. So that will provide, hopefully you can pick out your market on there and see where you qualify. So you can see 80 here, 80% loan to value, small and very small is going to be 75% and 70 for refinances. Fannie, however, will put it into a tiered system. So if they're going to look at the deal, they're going to look at the borrower, they're going to look at his net worth, they're going to look at his experience, his or her, apologize. They're going to look at the market, they're going to look at the property itself, and they're going to make a full picture of what the deal looks like. And based off that, then they're going to put it into their tiered pricing, which will then determine your loan to value. And this is just saying there's different criteria for student housing, senior housing, and manufactured housing. So that's that. We doing okay, Hadar? Any questions?
No, all good, Will.
Sweet. So yeah, I'd recommend just taking a picture of this here. These are top markets, standard markets, small markets, and very small markets for Freddie. And then I crossed out Dallas. Dallas is actually a top market here. And I included some standard markets, and shout out to Hadar and Little Rock. So I'll give a couple seconds and move on.
Is Little Rock on there?
It's right here. I included
Will,
it.
what's your email? I'm going to put in the chat real quick. Will at
randcre.com.
You don't use jakeanddino.com? Will at randcre.
No, I work for Rand.
No, I know. Will at randcre.com. I'm used to that one. All right. Got it.
Gotcha. Yeah, no worries. So another option is refinancing. If you have a deal, whether it's a community bank loan, whether it's an agency loan, refinancing is a great way to pull cash out, get better terms. I mean, rates are fantastic right now. So if you are going to refinance with agency, they generally really like to see 2 years of ownership. The minimum is 1 year. So you have to at least own it for 1 year. Once you get to the 1 year mark, you can then refinance, but you're probably not going to reach the max leverage that is available in the market. A good rule of thumb, it's not always the case, but it's generally going to be 90% of the original cost. So if your purchase price plus rehab is 10 million, the biggest loan they're going to be willing to give you on a refinance is going to be 9 million. So it's very important to document all of the rehab you're putting into the property, and just make sure that you're not missing out on that, because that could eventually reduce your leverage. Refinance, all the same qualifications apply. You still need to meet the occupancy requirements, the net worth and liquidity, and just keep an eye on what your prepayment penalty is, because when you refinance, it will trigger that. So like I mentioned earlier, loan assumptions, I think, are something to look into. Right now, creative financing, any sort of seller financing, master lease options, loan assumptions, I think are going to be huge in terms of getting deals right now, just because the lending has tightened up quite a bit. So I kind of just mentioned that there. A lot of times a seller won't be interested in selling because they don't want to pay their prepayment penalty. So if that happens, what you can do is just offer a higher sales purchase price, and that will allow you to mitigate their losses on paying the prepayment penalty. So that's just something to keep in mind.
Yeah.
Both Freddie and Fannie are assumable. It does take about 70, 75 days. And then if you're assuming the loan after 24 months, you generally will need third-party reports, but it's kind of a new third-party reports being appraisal, inspection, and things like that. But it really is a deal-by-deal basis.
One thing to mention, guys, is that especially in a market that is changing, perhaps we will see some cap rate expansion because NOIs are going to be a bit lower. So obviously the values might actually be decreasing. So if you are looking to assume a loan, you will need to go through the process, but you might need to do a little bit more research on the market before you even put your offer to make sure that you're not assuming a loan which might be equivalent to pretty much what the balance of the loan might be equivalent in some cases to what's the actual property worth. And then you're going to be in a situation that's a problem. You won't be able to take over the loan. We've seen a deal in Kansas City that was assumable, but what they still left owing on the loan was very close to what it was actually worth. So there wasn't really enough meat on the bone to get into the deal. So assumption sounds good. Maybe the terms will be great if the interest rates are low and the 30 years amortization and all of that. But you need to check your values because in a falling market, it could be tricky.
Yep. 100% agree. So right now, due to all of the uncertainty and the increased level of risk, Freddie and Fannie have implemented reserves, principal and interest reserves, meaning the amount of your loan payment, they're wanting you to put that in an account so that they feel better that you'll be able to meet the debt payments. Again, I would recommend taking a picture of this slide. It's a lot of information, so I'll sum it up. Basically, Freddie is requiring 12 months of principal and interest, and then taxes and insurance will need to be escrowed, meaning that you can't pay them yourself separately. You do need to escrow them, but you don't have to bring an additional tax and insurance reserve. Any deal that is 50 units or greater for Freddie, they're going to require you to bring 12 months of replacement reserves to the table as well. Fannie is a bit more expensive, I guess would be the right word, in terms of their reserves. So any deal that is less than $6 million on tier 2 pricing, means it's about 80% leverage. They're going to require 18 months of principal, interest, taxes, insurance, and replacement reserves. So
what's replacement reserve, Will? Can you explain what's replacement reserve, please?
Yeah, so replacement reserves are basically the lender will inspect the property and determine the amount of rehab that you're going to put into the loan, into the deal. So for example, if the roof looks like it's going to have to be replaced soon, they're worried about the cement in the parking lot or anything like that, they're going to determine what that amount is. And they're going to require that you escrow a certain amount per unit into an account in order that you can escrow that. So if you do have to make those capital expenditures, then you can pull from that account to use.
Yeah. So basically what we've been doing when we've been underwriting deals, we've been underwriting, for example, $300 per year per unit to be escrowed, perhaps even, which I'm doing it now, I'm depositing monthly from the cash flow. Well, what you're saying, Will, is that they will have to come with it up front.
Correct. Yep. And so we'll have to come with it up front, and then you'll still have to escrow those dollar amounts monthly.
Okay, so guys, this is a massive game changer. If you're in the business of raising money and in the business of putting a deal together, you need to take into account that you need to actually raise some more cash to go through the deal up front. Now, I just want to mention that community banks may ask you that as well. So, I mean, when I closed my deal in November last year, I was required to bring 12 months of loan services. So I had to deposit a certain amount into a deposit account, and I'm not allowed to touch it until further notice, until the asset is stabilized pretty much. So they told me up to 2 years. So this is not only agency, it could flow over to community. In my case, it did. Please, carry on, Will.
Yeah, so community banks, they're all different. So I would just recommend calling as many as you can to get a feel for what they're doing. Some are requiring reserves, some aren't, some completely aren't lending to new borrowers right now. So just check around. Some are still just as aggressive as they were a couple months ago. So you never know. So yeah, again, overall, Fannie Mae is just more expensive. Definitely would recommend taking a picture of this, but underwrite, 12 months principal and interest reserves for almost all the deals you're looking at least. Release provisions, Freddie Mac is a bit better. Basically, they're requiring that all federal, state, and local emergency declarations are considered no longer in a state of emergency. And then the following 90 days after that, you have to meet your DSCR requirement, meaning when the loan was set up, your NOI has to be 25% greater than your debt payment. And so for the 90 days after the state of emergency is taken off for state, local, and federal, as long as you meet the DS requirement over the next 90 days, then you'll be able to pull back from those reserves. Fannie is a little bit stricter. They're going to require 6 months to pass plus 2 consecutive quarters of meeting your DSCR. So it's a minimum of 12 months. So again, Freddie Mac is really much more competitive in terms of the amount of reserves being brought to the table, as well as the timeliness of getting those reserves back. So just make sure you're on your phone with your lender. A lot of lenders really only work with Fannie and only work with Freddie. So that's the benefit of working with a broker, is you can get a flux of both. And then some lenders work with both. So just make sure that you understand the difference, or call somebody that does. So forbearance, again, another slide with a lot of info. So highly recommend taking pictures, but essentially they're pretty close for both Fannie and Freddie. Essentially, if you're experiencing hardship on your property, and it's only if you're experiencing hardship due to COVID, you're able to not have to make loan payments for 3 months or for 90 days. And then you have 12 months after that to make those loan payments back. During those 90 days that you're not making loan payments, you're not allowed to evict tenants for a non-payment of rent. You can't evict if there's any criminality that they're performing. You can also not charge late fees, but you won't be charged late fees on your loan. And then you cannot collect any excess income from the property. So all of the excess income from the property is going to go to the lender. So just keep that in mind. And yeah, this is forbearance is really for only if you're, trying to avoid bankruptcy. It's not, let's just skip loan payments for the next couple months, or, we're going to be fine. Let's see if we can do it just to be safe. It's really a last dire situation type thing. And the lender is going to keep that in mind when you apply for it. So if you haven't really been affected, they're not going to just give it to you willy-nilly. So yeah, feel free to reach out if you have any questions on that, but it's really a dire situation. So yeah, that's it. I would say check out our podcast. We had, this is a great podcast in terms of creative financing. So Bill talks about seller financing, master leases, how the P&I reserves are affecting the financing environment. Definitely would recommend that. Mitch is a DUS lender at Arbor. So he's at the source of some of the better Fannie and Freddie loans. So it was a good discussion with him. And shout out, we've got Joe Fairless coming on next week. So yeah, and then this is our website, email, and all that. So
thank you, Will. That was great. And yeah, I highly recommend the Jake and Gino and the Run CRE episodes as well. They're all kind of uploading in the same show. If you subscribe to the shows on iTunes, or if you want to watch it on YouTube. And I also encourage you guys to jump on our YouTube channel, there's a link to that in the MIH Mastermind website. If you want to stay tuned with some recording of this, summaries of shows that we have participated in, and some informational videos and walkthrough properties and real deals playlist and various things. If you're interested, feel free to jump in. Thanks everyone. Marco, do you got anything else to add?
Yeah, I got something important to say. On this device, I build relationships. I don't like getting emails. There's a lot of people on the call that are already in my network. Whoever's not on this call and hasn't had a call with me, even if you have had a call with me, every week I set up networking calls that talk about market cycle learning. Text me if you're new, set up a call with me. We'll reach out, we'll build a network, we'll start building relationships. I want to build this from 3,000 to 4,000 to 5,000. So those are my goals.
All right, everyone. Thanks for joining us. We will review the questions and we might do a Q&A section if there are sufficient questions for this. We do another short video like we did last time. Stay tuned. See you soon and make it happen.
Thanks, guys. Thank you, guys.